Welcome to On the Sidelines, the show that discusses sports and how sports intersects our lives. I'm your host, Paul McGrath, and I'm glad that you can join us for this special show that deviates from sports, but brings us inside the sidelines of income taxes. As the income tax season approaches, a tax refresher and reminder can always be helpful. Since we have many small businesses here in the Westborough area, let us have a peek at the regulations and possible tax strategies in this area. We will also look at the tax situation for individuals, as well as discuss any possibilities of tax law changes due to a change in our political administration. I am pleased to have with me my colleagues from the Westborough accounting firm of Stowe and Degon. Prasanna Kindambi is the tax partner of the firm, and Westborough's own Mary Donati is as a tax senior manager. When you throw me into the mix, we have three CPAs who have well over 100 years of experience. So let's see what we know. Prasanna and Mary, welcome to On the Sidelines.
Thank you for having us.
Okay, well, I think we'll start with the businesses and some things you can do before year end, maybe some get ready for after year end. Prasanna, you want to give us a little rundown on some tips on businesses?
Sure. I mean, everything we talk here or we kind of advise here is on general terms. So before you do anything based on what you hear in this show, I would think that people should talk to their tax advisor before making any decisions.
Right.
Depreciation is definitely one of the more favorable tax advantages, as you can get the benefit for writing off an asset even before you actually spend the cash for it. So usually you can write off an asset even if you have a liability sitting in the books for tax purposes. Section 179 was put into place to encourage small and medium-sized businesses to make capital improvements and to grow their business.
But my understanding is, even though you may not have paid for it, you have to have used it for at least a day or an hour or so.
Yes, you should have placed it into service before the end of the year, so that you can take advantage.
Right.
Even if you place it into service only one day in a year.
That works.
It works.
Okay.
So 179, again, was put into place to encourage small and medium-sized businesses to make those capital investments and to grow their business. And it allows you to write off 100% of the asset value in the first year itself that you place it into service. For 2024, you can write off up to $1.22 million worth of assets. So that's a significant write-off that you can write off in the first year.
Yeah, and I know going back for a number of years, as I have, that number has been increasing.
When I started public accounting, that number used to be $24,000.
24,000.
Yes.
Or 22 million.
So it does start to phase out when you have placed into service more than $3 million worth of assets during the year. One good thing about 179 is also the fact that most states conform to it. So it not only helps reduce your federal taxable income, but it also helps reduce your state taxable income.
So what would happen if, I know we have many small businesses, but let's make believe they did purchase $1 million, and that put them into a loss situation.
Yeah.
What happens then?
So normally you can take 179 and be in a loss situation. So that usually doesn't work for like newer businesses which are just kind of which are just starting up. They usually don't make money in the first few years. So for those people, usually we take what is called the bonus depreciation. So the bonus depreciation has been around for over 20 years. The amount changes each year. And the rules are usually a little bit different, but for 2024, you can write off 60% of the asset value in the first year. This percentage goes down to 40% in 2025. The remaining, so if you write off 60% in year one, the remaining 40% can be written off over its tax life.
So, I know one thing, and from the accounting side, forget about the tax. Someone will call me up and say, "Hey, I can buy this big truck, and I got a write-off," and I'll always say, "Well, do you really need it?"
Yeah.
You've got to look at the business aspect sometimes. I know we're all hot to trot on the taxes.
Yeah.
But I think you have to look at the business side too sometimes.
I completely agree. And we say this often in all our tax meetings is don't let the tail wag the dog versus the dog wagging the tail.
Yeah.
Just buy some. If you're going to buy something in January or February because you need it for business purposes, it's a good idea to buy it in December.
Throw it back. Yeah.
But there's no point buying something for the sake of buying because now you're still out of pocket 60 cents that you didn't need to spend money on.
Yeah. Sometimes the ego gets in the way. I think, but.
And also, you brought up the vehicle example. Yeah. Don't run quickly and buy a vehicle before the end of the year. There are some depreciation limits on luxury autos and stuff. So people need to be aware of that before they kind of go ahead and start go use that money to buy a vehicle that they don't need.
So I think that gets back to talk to your tax advisor, whoever that might be.
Exactly.
Okay.
So that's where we are from a depreciation standpoint. The next thing to just be aware of is the qualified business income deduction. So the qualified business income deduction was put into place because if you remember back in 2017 when the Tax Cut and Jobs Act was passed, they reduced the corporate tax rate from 34% to 21%. And so they wanted to do something for flow-through businesses as well. So they came up with this qualified business income deduction. What it essentially does is, let's say you make $1 million in your S Corp. Normally what would happen is that $1 million would flow through to your individual return and you'd pay tax on that $1 million at the individual level. But what the QBI deduction or the qualified business income deduction does for you is that it gives you a $200,000 deduction against that $1 million. So now you're paying tax on the $800,000 instead of $1 million. There are obviously some rules and limitations surrounding it. So again, one should talk to their advisor before kind of utilizing it. But it's good. It's a good deduction to be aware of to make sure that you're picking up on your personal tax return.
Right. I think they're trying to get the tax rate down to that.
They're trying to bring that effective tax rate
even
down.
It off.
Yeah.
And again, the pass-through is, for example, the S corps or the LLCs. Those are companies, but the tax profits go over to the individual. Just as a reminder.
Yeah, that's absolutely right. So this deduction is usually even though it's a business-related deduction, the deduction is taken at the individual return.
It's on the 1040 of the individual's return.
Right.
Yeah.
The other thing to be aware of that I see this mistake quite often. This usually impacts smaller businesses. A lot of times, if you might be preparing your books on accrual basis, which means that as you record a revenue as soon as you bill your customer, whether the customer has paid you or not, or when a vendor sends you a bill, you record the payable in your books. A lot of times they keep the books that way, which is the right way to keep the books. But at the same time, you can prepare your tax return on cash basis, whereby you're not paying tax on something till the cash is actually collected from the customer. So we see this issue a lot of times on smaller businesses. Again, it might work for you or not work for you. It depends on the business itself, but it's something to be aware of. If your average revenues for the previous 3 years is less than $30 million. $30 million.
I remember back when it used to be like 3 million and then 5. And
it
that has also escalated over the years.
Yeah, so when the Tax Cut and Jobs Act was passed again in 2017, which was part of the Trump tax reform, they bumped this amount from like $5 million to $25 million. Yeah. And that amount is also now adjusted for inflation each year. Yep. So now we are up from $25 million to $30 million.
Yeah. And I think it makes it a little bit simpler for new business. And also, one of the things you're always looking at, if you have a receivable, is a bad debt. When do I write it off? How do I write it off?
Exactly.
Well, those questions are off the table if you're on the cash basis.
Right. If you haven't collected the cash, you're not picking up the revenue.
You're not paying taxes on it. So
exactly.
Okay, well, that's good to know. It's $30 million. I didn't realize it had gone up, which is a pretty good size small business.
Yeah, it's exactly. It now benefits the medium-sized businesses too.
Well, what happened once you decide to do that? Are you in other words, you hit 30, you go over 30 million, but then you go back down. Are you locked in? In other words, once you hit the 30, you have to go on the accrual, but are you locked in if you somehow have a dip for few years.
So if you have a dip, then you would have to go back on. So you in theory, once you make an election to be on cash method, you can stay on it for at least 5. You have to stay on it for at least 5 years.
Even if you exceed the 30.
But if you exceed the 30, you automatically move back to
then
accrual.
they move
so
you
if
back.
you're in the cusp, it's a little bit, you got to think about it and plan for it. But the one thing to keep in mind is also this 30 million is going to be adjusted for inflation.
Right.
It's probably going to be 31 million the following year.
So
you do get some leeway.
If your sales
there.
go with inflation, theoretically you're there.
You're there. And it's the previous 3 years. So in order to be able to use cash method in 24, your average revenues in 21, 22, and 23 has to be below $30 million.
Okay. Good target.
Yeah. Anything you want to add to that, Mary?
No, perfectly said.
With regards to the next thing to keep in mind is the Secure Act 2.0. There were a lot of different provisions that were there in Secure Act 2.0, which was trying to incentivize Americans to save more. We all know that Americans are at this point are not saving enough for retirement. So this was trying to put into place. They were also trying to give some incentives to employers to incentivize their employees to save more. So the few things that they came up with was if an employer who has less than 50 employees, who doesn't really have to have a retirement plan in place for his employees, if they put a retirement plan into place, they would get a $5,000 credit for the costs incurred in setting up a plan.
And I think the key word there is credit.
Yes.
Means
so it reduces your tax dollar to dollar
for dollar.
Yes. It's up to a $5,000 credit, so it all depends on how many employees you have and stuff. The other thing to keep in mind is that they're also trying to incentivize employers to contribute into their employee retirement plan. So there's up to $1,000 credit for contributing money into your employee's retirement plan. Again, it's things that people should be aware of. The third thing that they are trying to incentivize employers to do is to have an automatic enrollment feature. So if an employee has completed a certain time of service, they automatically get enrolled into their 401k plan, whether they have signed up for it or not. If they kind of do that, there is a $500 credit for 3 years continuously.
I think these are excellent.
Yeah.
I mean, I think the only thing we're rolling up in the U.S. sometimes is just credit card debt versus the...
Yeah.
Yeah.
The Inflation Reduction Act had a lot of different incentives for employers as well. One of the things was to keep in mind is that I usually tell these small businesses, if you own the commercial property in which your business is operating in, and if you have a good roof, then it's a good idea to maybe consider or look into having solar panels in your roof. Because if let's say you spend $100,000 in putting up solar panels, you get a $30,000 instantaneous credit. So now your basis in those solar panels is only $70,000. But instead of depreciating $70,000, the IRS also gives you, or Congress also gives you a kicker, whereby you're depreciating $85,000 instead of $70,000. So you might almost get 50% ROI in the first year, which is a pretty good return on investment in most cases.
Yeah, that's excellent.
Yeah. There are different ways to calculate these credits. One is the one that I just talked about. Yeah. There is also a production tax credit, which is calculated based on the number of kilowatts of power that the solar panels produce over the first 10 years. So you need some sort of a number crunch. You can only do one of the two. You can't do both.
Can you jump back and forth? Well, I guess it's a
No, I think it's a first-year election. So once you can jump back and forth.
Yep.
So you got to do some sort of a number crunching to see how much power you're likely to produce and which one kind of is more favorable to you. The one thing that I've heard clients say is that they put those panels in, they are ready to be turned on, but sometimes energy companies take a long time to turn on that switch. And keep in mind, because an asset has to be placed into service that we talked about for depreciation, the same thing goes for the 30% credit as well as for the depreciation on the panels. The asset has to be placed into service. So that means the switch has to be turned on by the energy company.
Now, we talk about it as production tax, or the word production. Does it have to be a manufacturer, or could it be a piece of real estate, commercial building?
Yeah, it could be a commercial real estate as well. Sometimes, like the tenants might decide to put it. That there are rules out there where the tenants can get the benefit of the credit. So you can kind of there is some flexibility there without getting into too much detail or nuances of it.
Yeah.
But it's something to be aware of, to kind of look into to see if it makes sense for your business.
So it sounds like this is one you have to plan a little bit ahead, not just in December.
Yeah, it's not something that, I don't think if you decide to do it today, you're not going to have your switch
That's not
turned
gonna
on by
happen.
the end of the year.
Yeah. Okay, well, that's a good one.
What's next? So the other thing, this is not really a tax rule, it's more a legal implication, but we are trying to make clients aware of it because the penalty for not doing this is significant. The Financial Crimes Enforcement Network, which is overseen by the Department of Treasury, they've come up with this requirement called to file something called a beneficial ownership information reporting. So this is primarily applies to small businesses. So if you have less than $5 million in revenue and less than 20 employees, you are supposed to report who the owners of the business are or who have control of the business. They define who the owners are by a 25% rule. So if you own more than 25% of the business, or if you own less than 25% but you have control of the business, you have to report the name of the person who owns the business, their address, the driver's license. It's a pretty simple form to fill out. I filled this form out a couple of times for different clients, but the penalty for not doing it is pretty high. It's almost $590 per day.
Yep, $591 civil penalties per day. And in addition to that, if you willfully did not file, they can hit you with a $10,000 fine and 2 years in prison for a form that's really, as Prasanna said, simple to file and free on the government website to file.
Exactly.
So this sounds like, you talk about this so-called bad actors try to get at them. And they have a company that's owned by a company that's owned by a company.
Yeah.
So all these little old companies, they're trying to get at...
Who is the ultimate owner?
Who's who?
Yeah. They're trying to figure out who is the ultimate owner. That's what it comes down to.
Yeah.
There is a lot, they want to reduce the impact of, or understand if there are foreign owners in the business, who those foreign owners are.
And this is not the IRS.
This is the Department of Treasury.
Department of Treasury.
Yeah, so that's why it's not more a tax thing. But since the due date for this is coming up, so if you have a business that was existing before January 1st of 2024, they have to file it before December 31st of 2024 with this form. And if you set up a new business in 2024, this form would have had to be filed within 90 days of setting up this new business.
And then it reduces in 2025 to 30 days within setting up a business. So they're really trying to make individuals who have these businesses report who the owners are quickly.
So when you start a business now, that's going to be part of really the incorporation or the...
It should be.
Whatever
Yes.
the forms might have to be.
I mean, I've seen a lot of attorneys not wanting to touch this because it has a criminal penalty associated with it. But in theory, people should be aware of it and making sure that either their accountant or their lawyer or they themselves, like I said, the form itself is easy to do. Yeah. So they should be kind of making sure that it gets done.
So is this a one and done or?
So it's not an annual filing. That's a good question. You have to do it when you set up a new business or if there is a change in ownership in the business.
Yeah, plus all the companies that have been in business.
Yeah, plus
back when?
Yeah.
This is the first year.
This is the first year.
So if you have a change in ownership or control, I guess, then you got to go back in. Somebody's got to remember to do that,
Somebody's got to remember it. And a lot of times, like we as accountants don't always, like every time there's a change in ownership, a client is not calling us and telling us that. Right. So it's important that the business owners are aware of this.
Okay, new and improved, I guess.
Yeah.
Uh-oh, what's next? Looks like, Mary, we're going to let you go for a little while.
Yeah, we're going to talk a little bit about some ideas for saving taxes and if you're an individual. And one of my pet peeves is clients calling in and saying to me, how can I reduce my taxes? And the first thing I say to them usually is, show me your W-2. And I focus in whether their employer has allowed them to has a pension plan or retirement plan, and if they're contributing to it, because that is the easiest way to reduce your taxes. Example of this is if you are over 50 in 2024, you are allowed to contribute $30,500 to a plan. And if you're in the 32% bracket, that's a savings of about $9,760.
And again, it's up to. You don't have to put the whole 30.
Correct, you don't have
5,
to.
10, whatever
And I understand that there are a lot of people who are in a situation where their cash flow is tight. So what I usually say to them is, hey, you're only putting in 4% of your income into a plan. Let's increase it to 5%. And that nominal increase every year till you get to 15% does have a good effect. So, that's the first thing I've always say is, let's look at your retirement plan. Do you have one at work? If you have one, contribute to it. If you don't, can you pressure your employer to get one? As Prasanna had said during the business part, there are really benefits to having a plan.
It's benefits on both sides.
Yes, correct.
Absolutely.
And if you still can't get one, you have the old IRA that you can possibly contribute to depending on what your situation is. And there are a lot of nuances to it. If you have a wife that works or a spouse that works, you may not be able to do a traditional IRA, depending where your income limit is. But those are things to talk about with your tax advisor or your investment advisor.
Right.
But there are options out there. And the great thing is in 2025, for people who are between 60 and 63, there's a boost up to the amount you're able to contribute. And that, once again, is, as Prasanna had talked about, is the government realizes people aren't putting away money into their retirement accounts.
Right, and not only that, but Social Security is, people are concerned about, if that doesn't scare you into saving, what's going to happen to Social Security?
Exactly.
Maybe that's another incentive.
Yeah, so, that is the easiest thing to
Right.
do to reduce your taxes. And I really encourage people to check out what they can do to save, because that is a tax deduction for the most part.
Very good.
Okay?
I wonder how they came up with that 60 to 63. Too bad if you're 59 or 64.
Well, the other side of it is
You don't want to know some of these answers either, Prasanna. But
the other side that does bother me is they didn't do it for IRAs.
They only did it for 401ks.
401ks or
401ks.
in simple plans. Simple
Yeah.
plans also have that option for a catch-up, but they decided IRAs don't count. So they either missed the mark or forgot about
well,
it.
I think we'll let that alone for now.
Yes. So the other thing that is out there that, a lot of people do is, they contribute to their favorite organization, charitable organization. And that is a great way to reduce your taxes if you can itemize. If you cannot itemize, there are things to look into especially if you're over a certain age, if you're over, I think if you're obtaining, let me backtrack that. If you are able to take money from your IRA,
An RMD.
you can do what they call a qualified charitable distribution, and that will reduce your taxable income on your tax return. What happens in essence is that distribution doesn't go to you. It goes to whatever charity you have.
But it has to be direct, right?
It has to be direct. You
I
have to work-
can't write the check. It
No.
has to come from wherever
Yes,
the
you
money
have to
may
work
be.
with whoever
Right.
the investment advisor is. And then you also have to tell your accountant that happened, because we're not mind readers. And it won't be on the 1099-R that we receive that says, hey, I made a qualified charitable distribution to XYZ charity. We won't know that. You have to let us know that. But the great thing being in Massachusetts now is, they are now allowing charitable deductions on the tax return. So you may not be able to itemize your charitable deductions, but you will be able to obtain a charitable deduction against your Massachusetts taxes. However, it doesn't count for things like goodwill. If you donate your used clothing,
non-cash,
there are
yeah.
some exceptions, but Massachusetts does now have
So,
that.
so in effect, that's a 5%
Benefit.
Benefit,
Exactly.
correct, yes.
Save 5% of your taxes.
Yeah.
But there are some nuances with, charities that a lot of people forget is, this was an election year. Your donation to your favorite candidate, that will not be a tax deduction.
Even if they won.
Even if they won, no. And the other thing is that people don't realize is, those wonderful GoFundMe pages, they are important to help your friends, neighbor, family members.
Yes.
But they are usually not a qualified charitable deduction. So you give in $500 to, the person down the street who unfortunately may have had, a terrible medical problem. Unless it's been set up as a qualified charitable distribution, that GoFundMe page is not a tax deduction.
And there's so much, the cost to it and the paperwork to setting it up for a one-time GoFundMe probably isn't worth it.
Yeah.
But it's probably a valid cause. It just doesn't qualify.
And that's not to say there aren't charities on GoFundMe that are qualified. But for the most part, that money you're given is a gift.
Right.
It's not a charitable donation.
Right.
And that's what people fail to realize.
Right.
So there are other things to think about, at the end of the year. You have energy efficiency credits. And this actually happened to me, I put a new boiler in, and I did my own tax return. And I usually put it...
You didn't use Persona?
No. And I put it aside, and I think about it. And then I'm like, holy crap, I forgot I had a new boiler. So these are things you should be thinking about. Did I put in solar? Did I buy an electric vehicle? Do I have a new heater?
Windows.
Things that may qualify for a credit on your tax return. This is a time to think about it, and maybe you still have time to put it in, especially if you need a new water heater. Should you do it now, or should you do it in 25?
Many of those sound like they're key to energy. How do we save energy? I mean,
Correct.
your boiler,
Yes.
your
There are.
heater,
Yes. Yes.
a vehicle.
Yes. Correct.
so-
You are right on that.
And who knows what will happen with the vehicles? We'll talk about potential laws down the road. But anyway, carry on.
So there are other things to consider now as it's the end of the year, and this is stuff you talk to your investment advisor. This has been a great year for the market, so you may have capital gains that you have realized during the year. So now it's time to talk to your investment advisor to see if you're sitting with capital losses that can offset those capital gains. Or maybe it's time to talk to your tax advisor, because the fact is you have carry forward capital losses. Do you have gains that you want to realize right now to offset those large capital losses that are just sitting on your tax return? So these are times to talk to your financial advisor and tax advisor about capital losses, and do you have any?
Yeah, the one term I heard back when, I don't know when, from the client got a kick out of it, is his advisor said, it's time to harvest some loss.
That is the
harvest
word.
a loss, but
Yeah, we are harvesting losses. And the thing about harvesting those losses, a lot of people like certain positions they're in. They like XYZ company in their portfolio, but it's sitting with a loss. They got to be also concerned with the fact that, they're thinking, I want to have this company back in my portfolio. So they sell it, but they do not want to buy it for 30 days. They want to buy it on the 31st day, because what happens is what they call a wash sale.
Right.
So that loss you just harvest, poof,
doesn't
gone.
count.
Doesn't count.
You've got to wait those 30,
So
31
that's
days.
why it's really important to speak to a financial advisor, your tax advisors, to make sure, you're not screwing up your harvesting of your loss.
No, but that's not bad. I mean, you have that company that you love, you get the benefit of the loss, and then hopefully after your 31 days you buy it and it comes back.
Yeah.
So not a bad deal.
No,
Not
but
at all.
no, it's not a bad deal. But for those of us who are in the crypto world, don't
look at me, but go ahead.
me either. You can harvest your loss and buy it back within an hour, because crypto is not considered a financial instrument, as it's not considered a security. So harvesting losses and buying back your position within an hour doesn't apply to the crypto world. And while we're speaking of crypto, I just want to remind people that, who have crypto, you buy something with with your cryptocurrency. That's officially a gain that has to be reported on your tax return. And that's what a lot of people don't realize, is that every time you do something with crypto, you donate it, you had to, enter into a transaction which could be taxable to you, and maybe, but so it's very important to realize crypto does have a lot of
So Mary, we
possibilities
have,
of gains.
the clients send in at the end of the year their brokers reports. It shows all the buys and sells. Where do you get the crypto? How do you get your crypto information? Is that up to you, or?
Well, in years past, the companies who handled crypto didn't have to do anything to report.
There was no reporting requirements. Right.
And it was up to you to figure it all out.
Good
but
luck,
now the IRS has hammered it down, and I'd like to say it's 2025 that they're supposed to be issuing 1099s. But don't hold me to that. It could be 2025. They were allowed a couple of years to figure things out.
Come up with a system? Yeah.
Yes, come up with a system. So
what are we on, the honor system now?
We are. I think especially if you're in an unregulated crypto market,
right,
it's very hard to find those reports. But there are tools out there that you can run those activities through those tools that will help you provide the gains and losses associated with those transactions.
And it's important also to say that this is something the IRS is looking into, because right on the front page of the tax return, there's a checkbox that says, do you own? Not even did you sell, do you own cryptocurrency? And I also want to point out, I was just looking at the Massachusetts draft return for 2024, and they have changed their wording. Before, they had a box on the front page of the tax return which said that, did you sell any crypto? But now, at least on the draft return, who knows what the final return for Massachusetts would be, but the draft return now has almost the same wording as the federal return. Do you own? Did you sell? Did you donate? A large wording. It's a circle. Check it off if any of these things apply to you in the crypto world.
Well, I think it's getting larger and larger. I know we had Donation Tuesday here in December, and I know you're inundated with solicitations for donations, but I know some of them say we now accept crypto. Yeah. So the world's out there. It's out there. All right, Mary, we have to listen to you.
Yeah.
Go ahead.
All right. So some of the other things you could do by year end is what we call is make sure you're taking all those pre-tax deductions on your tax return, on your paycheck. And we had talked about maximizing or trying to increase that retirement plan if your company offers one. But if you have an HSA, those are other things that you should be checking to see if you maximize the contribution through your company to your HSA plan. So those are other things to be looking at. Some other things to consider before year end is making sure, if you are of that age, that you're taking your required minimum distribution. And because if you didn't, there are penalties for not taking required minimum distributions, and they can be substantial until you finally have caught up with those. And what we also have found recently is there are a lot of people now who have inherited IRAs. So it's important to make sure you talk to your financial advisor, your tax advisor, because there could be implications to you of inheriting Uncle John's IRA, and that would be a required minimum distribution that you have to take. And you might be saying that,
even though you're not the age.
Even though I'm only 50, I don't need one, but Uncle John was 75. You may have requirement to take a distribution. So you need to talk to your financial advisor and make sure your house is in order. Okay. And the other thing to consider at the end of the year, and this is not something to jump into, but it's a conversation to have your tax advisor and your investment advisor, is rolling over your IRA into a Roth. If you're in, a certain tax bracket, that might be an ideal situation for you to consider doing, because there are such great benefits to having a Roth over an IRA.
Yeah. Okay.
All right. So the other thing I like to talk about, and once again, this most people think has nothing to do with taxes, and it really does, is, we are now in a society where identity theft is running rapid, fraud is running rapid, and people, we're relying on various companies to protect our information, and they're just not doing that. So we are now sort of suggesting, the IRS offers an IP PIN. And what the IP PIN is a six-digit number that changes yearly. And it is aimed at preventing someone from fraudulently filing electronically a tax return in your name. And it really does work. It won't stop someone from filing a fraudulent return by paper, but it is to stop someone from filing it fraudulently electronically, because there's only so many times you can file a return electronically that needs that six-digit PIN. And
Right, because when they do it, they want to file before you do.
Correct.
So they're doing it early,
Yeah.
and then you go to file, and whoops, sorry, you already filed.
Yes. And unfortunately, we've seen that happen in our office, but we've also seen people who have gotten an IP PIN forget to tell us about it, and their return bounces, and we're like, you got to give us that IP
So
PIN.
how does one get an IP PIN?
It really is easy. Go to the IRS website, and they're going to send you to another website, ID. They're going to send you to an ID. It's another government website where you're going to upload your license or passport. You're going to need.
It's secure. I hope this site is secure.
Yes, of course it is. I think it's probably because they within 30 days they delete everything, so it is a secure site.
So
at least
that's
what
Mary.
what the site says.
Okay, Mary.
So you're going to upload and then you're going to take a picture of yourself. So you're going to need a computer that has that ability to take a picture of yourself at the time, and it really is an easy process. I recently did it. And I did it crazily at 11:30 at night, and it cannot be easy. But cannot be more easier. But if you are a person who's averse to computers, you still have an option of doing it the old-fashioned way with a form that you mail into the IRS with all that information.
And a picture, I suppose.
Yes, yes, correct. So, but it is recommended, and
Okay, and you said that the number changes every year, but they send you that number, I take it.
If the old way, if you did your IP PIN years ago, they are mailing you something. But when I did it, now I have to log into ID Me every year, and they'll give me my new PIN number electronically. So, but it is worthwhile doing. And I've seen a friend of mine who actually ended up having her identity stolen, and a return was filed in her name. She was married to someone else who had his identity stolen. So two different people, they don't know each other. They're now married on a tax return. So it does happen.
That's going to be a costly divorce. Get out of all this wrangle.
So it does happen. So, do what you can to protect yourself, because nobody else is. These large
you've got to take care of yourself. I agree, Mary.
Yeah.
Okay, carry on.
Carry on. So there's also state of Massachusetts, the DOR has an opt-in program where you can, through Mass Connect, find out if they'll send you notification when a return has been filed in your name. It's not preventing a return from being filed in your name, but you're being notified a return has been filed under your ID number. So that might be something to consider too, but I definitely recommend the IP PIN with the IRS.
Good advice, Mary.
Okay. I could also say this, if your return you did obtain an IP PIN, and you do need it to file your federal return electronically, and a return is filed without that IP PIN, the Massachusetts does reject the return electronically that goes to the state that's being filed with the federal return automatically. Your federal return's been rejected because the IP PIN isn't there. Your state return has also been rejected.
Great news. Yeah. Okay.
So just a heads up, there are a lot of wonderful things that happen with the Tax Cut and Jobs Act that are set to expire in 2025. Don't know if that will happen. You know, new Trump administration is coming in. These were Trump's tax cuts, so he may extend them, he may change them. So just to be aware, 2025, I have a feeling, will be a year of tax changes,
yeah.
which is always great for us. It keeps us in business. But I could foresee that happening. Good or bad, something will be coming down the pipeline.
Well, I know the one that a lot of people talk about is that the limitation on tax deductions, whether it be your state taxes, your real estate taxes, at least it should be maybe indexed or something, but it's been capped for so long.
I've heard rumblings that he may change that a bit, but you know, that was, he put that in place as a I got you, you blue states who didn't like me. That's what I think, but.
Yeah, well, stay tuned, as they say.
Yeah. And then, of course, I just want to point out right now, Massachusetts is running their tax amnesty program. So if you find yourself from November of 2024 through December of 2024, that you may be behind filing some taxes, you may want to speak to someone. This is a great opportunity to catch up in your Massachusetts state taxes. And that doesn't apply to just individual taxes. Mm-hmm. It's corporate taxes. So, you know, it encompasses a lot of different taxes, not just individual. So this may be a time to catch up. And a lot of people do fall behind because for many reasons, most of it is there's an aversion to paying taxes.
So penalties and interest, are those abated or minimized or?
Penalties will be abated during the time period. Interest is never abated.
Right.
But the penalties
it's still not bad. The penalties can exceed the interest.
Yeah.
Yes, and they can be quite severe, you know. So something to look into. And I think that the only other thing is to let people know that coming down the pipeline in the state of Massachusetts is it has passed in law, if you're a non-resident and you sell a house in Massachusetts over $1 million, there'll be a new requirement for state withholdings on it, which it happens in a lot of other states, so I'm not shocked that Massachusetts has gone in this direction because the state of Maine does it, California does it, New York does it. So the law has passed, but they're still working out the details, so there's not an effective date when this will start taking place.
But the key is non-residents.
Non-residents,
because
correct.
$1 million houses now are.
They're all over.
They're all over the place.
Yes,
I mean,
yes. All over
that
the
might
place.
be a low threshold the way it's going.
Yeah, it is. It is.
Yeah.
And then, of course, we have the millionaire's tax, which came into place in 2024. 2023, I'm sorry. But in 2024, you can no longer get out of the millionaire's tax with the little loophole that was there that you filed your federal return jointly, but in Massachusetts, you filed it single to get out of it. Now, if you filed your federal, in 2024, if you file federally, you have to file federally in the state of you have to file jointly in the state of Massachusetts.
And there's no threshold on that.
No threshold.
No, but one good thing to evaluate is in totality, does it make sense to file separate for both federal as well as for state? Because now we always look at it to see if somebody should be filing jointly or separately and whether it saves money for the family. So now you got to add that layer of surtax into it to see if doing it separately for both jurisdictions makes sense.
So maybe everybody was moving to Florida to save taxes, or maybe the one would want to stay in Mass. But again, talk to your advisor, look at the situation.
Yeah.
And if you're one of those people who moved to Florida to get out of this tax, you really want to make sure you had dotted your I's and crossed your T's, that you really have moved out of Massachusetts. You know, you don't still have membership at the local, country club. Your kids aren't going to public school in Massachusetts. You'd be surprised of the stuff that Massachusetts is catching people that really are Massachusetts residents still, but have just sort of just changed their address in their driver's license to Florida.
And I vote down there, yeah.
Yeah, you know, but that doesn't make you official residents until you completely have separated everything in Massachusetts.
It goes back to the old adage, I think, substance over form.
Yes.
Exactly.
What's really happening.
Yeah.
Exactly.
All right, any thoughts on next year, what may happen, or we just stay tuned?
Yeah, I mean, like Mary said, it is pretty interesting times, at least for us tax people. Usually when there are these significant changes, there is a lot of new things for us to learn and a lot of different nuances for us to understand. Trump, the Tax Cut and Jobs Act that was passed by President Trump at that time had a lot of different tax cuts, like the maximum individual rate was 39.6 at that time. It was reduced to 37%. We talked about the qualified business income deduction that was put into place. The estate tax exemption was almost doubled at that time. So there are a lot of different tax cuts that are supposed to expire at the end of 25. And even though the Republicans have what they call the trifecta, they don't have a 60-seat majority in the Senate. So they can't overcome a filibuster. So anything that they do, they will have to do it as a part of a reconciliation process. So in order to kind of give any tax cuts, they would have to generate income within that 10-year window in that reconciliation to make it happen. So if President Trump wants to continue with his tax cuts, he would need almost $4.3 trillion in his reconciliation process. And he also wants to do a bunch of other things, which is to reduce the corporate tax rates from 21% to 15% for U.S. manufacturers. He wants to exempt tax on Social Security income, on overtime, on tips. So there's a lot of other things he would like to do. If he's able to, or if he wants to do all those things, he would have to find almost $8 trillion as a part of the reconciliation process. So some of these things would be easier said than done. They would have to kind of figure out a way to do it. The Department of Government Efficiency is probably one of the things that is trying to do some of those things, but that cutting expenditure is not going to be enough. They would have to figure out ways to raise more revenue, and which is why the tariff conversation is back in the table. So we'll have to see what are some of the things that not everything they're going to be able to do. We'll have to see what they are going to be able to do in order to get some of the things that they want done.
So stay tuned.
Stay tuned.
But definitely at the end of 25, there will be changes.
There will be changes. We just don't know what they will be.
All right. Well, Prasanna and Mary, my colleagues from Stowe and Degon, thanks for joining us, giving us a little bit of updates and what to do here for taxes.
Well, thank you for having us.
Thank you for having us. My mom would be proud that I'm on a sports show.
Well, we stretch it a little bit. And this is Paul McGrath saying, thanks for watching. And after you get your taxes done, maybe you can go to the game. And if you're not in the game, I hope to see you on the sidelines.